Well, welcome to our weekly High Rock video. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at www.highrockcapital.ca. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. Today we're going to talk about our three asset models and any updates on developments in and around our tactical strategies and what we see happening in the global economy, financial markets, and other issues pertinent to the world of wealth management. So let's start with global equity markets. It is first quarter earnings season now, but we really have only seen about 20% of the S&P companies reporting thus far. And although earnings are coming in at about expected levels, the forward-looking investors are beginning to get concerned about what happens to earnings growth after all the tax deduction factors are in the market. Now, stock prices have built in about an 18.5% earnings growth for 2018, but estimates for the first two quarters of 2019 are looking pretty flat. So it's difficult to get any further excited about stocks with little earnings growth happening at the moment. If we look at the global equity market through the All-Country World Index, prices peaked at the end of January, and through February and March, investors started to consider forward earnings for 2019 as among other things, but prices started to move lower. And with all the good news baked into the markets may still need to test some buying support at the longer-term trend line.
Scott, what about that big move over the last kind of 2.5 years? Yeah, there you go. What kind of retracements would you look at that whole move?
So we look at the trend line, the uptrend line, which is the longer term line, and we say, okay, well, that's been holding buying support for quite some time, and now if that gets tested, if that doesn't hold, what happens next? Well, we think that about a 50 or 60% retracement back to these lower levels will represent some good value for potential buying, and we're going to wait and see how this all trades out over the course of the next few weeks. And as you mentioned a couple of weeks ago in a couple of blogs, Paul, the market looks coiled and ready to spring one way or the other, either up or down. And right now, the momentum seems to be favoring the downside. But again, we'll see what happens when the market tries to retest that support line.
Yeah, and I was writing that blog, a couple blogs on the Dow being coiled up, but that certainly is not as broad an index as the ACWI for sure. Yeah. And you know what? These charting techniques kind of really do depend on where you draw that line, doesn't it?
Yeah, I mean, the lines are fairly relative, but you can look and see where there has been support historically and in the past, and you can see that and where there's been selling resistance again as well. So all of these things come into play when we're looking at the short term. I mean, obviously we utilize cash when we think that there's relative value in the market, and of course we're sitting on anywhere between 20 and 25% for our clients at the moment. So let's talk a little bit about correlations. We've seen bond yields rising over the course of the last week or so, and stock prices fell, as we said, and have kind of been going slightly sideways to slightly higher, although coming off the end of last week. So what do we see, Paul? What do you think?
Well, I mean, as you can see in that white line there, the start of April, it's been a pretty tough month for government bond yields. They've increased anywhere around 20-25 basis points in the 10-year sector, both Canada and the US. But the correlation is still holding reasonably well. I mean, if you look at the end of March, beginning of April, stocks in the yellow line are higher than they were over 3 weeks ago, and bond yields are higher. So they're both not both. They're behaving in a correlated fashion about the way you would think, but it's still kind of a tricky call. Yields do seem to have upward momentum in them right now, and I can tell you, Scott, on a anecdotal or daily basis, just watching on intraday basis, we've had days where they both have gone in the same opposite directions, yield and stock market price. So those are days where the correlation kind of gets a little wonky and goes out of whack, as it did back in late January, early February, as you can see that little dip down in the bottom half of the chart.
And if you have a 60% equity, 40% fixed income portfolio, you're not getting over the last few days, anyways. You're certainly not getting any relief from stocks holding the portfolio up as bonds drag the portfolio down, right?
Yeah, I think you need to see really big, days where the Dow is down 300 points, and then the bond market seems to perform much better as you get that flight to safety or flight to quality that moves out of stocks and into bonds.
Right.
The same thing in Canada, right? I mean, the TSX in the white line is higher than it was 3 weeks ago, beginning of April, as our bond yields. So the past few weeks, again, they've been moving in the pattern that you would expect. But as you said, that's not always. They're not always days where they're moving in the pattern that you would expect or like.
And that sort of brings up one of the other key components of our portfolios, right? I talked a little bit about this last week, but maybe you can talk a little bit more just to bring in the rationale for what we call high yield bonds, so Canadian high yield bonds, for that matter.
Sure, I'll be kind of quick on this, but and anyone feel free to contact me if you would like to dig in a little deeper. But these are basically three different asset classes that we've picked that typically investors would use to pick up yield, and they are the Canadian High Yield Index, the Canadian Investment Grade Corporate Bond Index, and the Canadian Preferred Share Index. And what's really interesting here, and these are 5-year monthly total returns regressed back over 5 years. So you can see highlighted in yellow, Canadian dollar high yield has zero correlation to Government of Canada bonds or even U.S. 10-year Treasury, so what we call rates. Has zero correlation to interest rates. So when people talk, I had this conversation with prospective clients last weekend. When people talk about bond yields going up, not all bond yields are going up. High yield has performed very, very well for the last year and a half that bond yields, government bond yields, have gone up. So that is an asset class that we certainly utilize, given we do manage a fund for Bank of Nova Scotia that is pure Canadian dollar high yield, but also in our private client books, because it gives us, it's a low correlating asset class that gives us some very good low volatile type returns. Canadian investment grade bonds, on the other hand, as you can see in blue, are 88% correlated to Government of Canada yields. And Canadian preferred shares are negatively correlated to Government of Canada bonds by 23%. And that's a very interesting one. That's one of the changes we've made over the last couple of weeks in our our fixed income model in the preferred share portion, where we've actually sold out of our rate resets and started buying a fixed rate preferred share. But I think, Scott, those are a couple of really good examples of understanding risk and understanding correlation, which helps us understand risk.
Excellent. Well, and it's one of the reasons why we have expanded the asset classes that we utilize in our portfolios away from traditional fixed income or bonds that we would classify as protection, and then strictly equity, which would be the growth side. We're trying to intermingle to lower correlations, and at the same time, by virtue of that, lower the risk factors in a portfolio.
That's right.
Okay, one of the other things that, sorry, Paul, much to talk about on curves, not a lot really. They've slightly widened this week. They have been quite a bit narrower and flattening, and over the last week we've seen them widen just a little bit. Any comment on that?
Yeah, I do have a comment on that. Both Canada and the U.S. have done the same thing. They've widened out a SNC over the past week, but I'll tell you, if any clients are paying attention in the press, over the past week, you've seen everybody start talking about the yield curve flattening, its potential precursor to a recession, blah, 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 blah. And not to toot our own horn too much on this, but we've been obviously talking about this the last number of years and keep a close watch on government yield curves and what they may be telling us. So it is kind of, it makes me wonder a little bit if the curve has flattened a bit too much, given that all these journalists have now picked up on it and they're interviewing guys and everybody's talking about it. Maybe we're going to go through a little bit of a period here where the curve steepens a SNC, but I still think overall the bond market is telling us something, and that yield curve flattening is the something, and the something could be an economic slowdown caused by an error by the Fed. I don't think the Bank of Canada, by the sounds of Governor Polis' speeches lately, that the bank is about to make any sort of monetary policy error. But I think the Fed very well could, and I think the Fed very well could raise 3 more times this year, but it will likely lead to further yield curve flattening in a recession. So every recession starts with the Fed hiking rates too much, too fast, too quickly, too soon. So we'll see.
And part of the steepening of the Canadian yield curve last week was after the CPI data and the retail sales data on Friday. When we probably saw 2 years yields come down a little bit, right?
Yeah, absolutely. And the Canadian dollar subsequently has weakened as well.
Right.
Probably by about 3 points or so.
Yeah. And speaking of CPI, consumer prices now at about 2.3% for all items. A lot of that has to do with gas. That was a significant increase. I think the energy component was up like 17% or something over the course month to month over the course of March. And of course, the SIN CPI data, alcohol and tobacco, also helping push things a little higher. And of course, as I always say, it depends on where you live. If you live in Saskatchewan, you're going to be a little closer to 3%. If you live in Quebec, you're under 2%. So again, we have to keep an eye on these things. Cost of living, we all have our own cost of living, depends on how we consume. But from a wealth management perspective, it's something that's very important because we have to look forward and utilize what we expect to be a change in somebody's cost of living over time, and then utilize that number to help to prepare well forecasts going forward. So always have to keep a close eye. And as Paul was saying, it is also something the Bank of Canada is watching closely. And if the Bank of Canada is concerned about rising inflation, of course, they're going to raise interest rates. At this point, it seems like they're less concerned about rising inflation at the moment, a little bit more concerned about which direction the Canadian economy is heading in. All right, well, that's it for this week. Again, thank you all for tuning in and taking the time to do so. If you have any questions or comments you want to get to us, please feel free to email us or call us. We're always available to talk or exchange emails. And we want to use some of the things that you're interested in hearing us talk about. We'd love to bring them to all of the rest of our clients as well. So again, thanks for tuning in. We will be back with another edition next Tuesday. And until then, on behalf of Paul and Bianca, I wish you all a wonderful week.